So you have a limited company, great. Now you've got to prepare a set of company accounts. Let's have a look at the small company accounts today. Hi, I'm Kimberly Shapcott, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. So you have a limited company and you need to create a set of company account. Now I definitely recommend using a qualified chartered or certified accountant, because unless you're trained in preparing a set of accounts, then it's probably not something as a property investor you necessarily want to be learning. However, today I want to go through what a set of accounts looks like, because that is very important that you understand what is being produced for you. Now, on a micro company accounts video, we've gone into what a set of micro company accounts is. Today, we're going to be looking at the small company set of accounts. Now, a small company set of accounts is for any company that is below 10.2 million turnover, 650,000 asset value, net asset value on the balance sheet, and under 50 employees. So for a lot of property companies, this definitely ticks the box. Now, the key thing here to mention is there is different accounting standards. One is called FRS 105, which is Financial Reporting Standard 105, which is all about micro company accounts. Now, check out the separate video on what a micro company is and how that fits together on the channel. Today's focus is the small company accounts, which I really think is the one that a lot of companies with property are going to be doing, and there's a couple of reasons for that. But where do these regulations come from? Now, for small company accounts, we are going to be using Financial Reporting Standards 102 and a specific section in those rules, regulations. And this is Section 1A. Section 1A allows us to get rid of loads of the disclosure that the full standard does not need to do. But there is certain things that we still have to do as part of this financial reporting standard, which means the micro company accounts can be better if you don't want to disclose anything, but there are restrictions. And the key restriction that is probably worth mentioning is about revaluations. As a property investor, I buy a property, I want to do something with it, and I want to add some value. And then in my accounts, I do usually want to revalue it up to a higher value. In the micro company accounts, we can't do that. You have to include it at the value that you purchased it for, plus any costs that you went. So you're not able to do that. But in the small company accounts, you can do that, which is why it's so much more attractive as a property investor to be doing a small company set of accounts. So what are the negatives? Well, the negatives are there is a little more disclosure than would be in a micro set of account. But we'll go into that in a second when I show you a set, as there's more disclosure, but it's still not every single disclosure that is out there, which you'd have to do with the full set of accounts under the Financial Reporting Standard 102. Now, let me dive in to a set of accounts. And what we'll do then is we'll go through what is happening in those accounts, what is included, and how it fits together. Now, the final thing to mention before we dive in is what a set of filleted accounts are. And a filleted set of accounts is basically the ones that get sent into company's house, which is where we can all see everyone else's company accounts. Now, a filleted set of accounts is basically a set of accounts with the profit and loss and any other notes taken out. So it does restrict what the world can see about our companies, but there is a few more disclosures that are still there because all the balance sheet disclosures are available to see. So let's have a dive in and see a company set of accounts with my demo company, and then we can just go through a few of the different aspects to make you aware of what you're going to actually be seeing when your accountant pulls together those set of accounts. So as you can see now on screen, we have got a set of company accounts, and if you've watched the micro accounts video, it looks very similar. We have got a set of company accounts which has our registration number on. It has the name of our company and it has the statement unaudited financial statements. Now that is quite an important phrase because if a bank asks you for an audited set of accounts, that means you've got a statutory audit to do. There's a lot of paperwork to do on it and a lot of checks. Now most small companies will not need a company audit. Anything under the 10.2 million turnover isn't required to have one. So your accounts normally will be unaudited, unless there is a reason why you need to specifically have an audit. Now, it'll tell you the period that it's covering, and then that's pretty much it from the first page. The second page tends to be a contents page. It's not a necessity, it's just a nicety that we all tend to put in there. So it covers what is going to be in those accounts. Now, the next page here is one that tends to be included within a small company set of accounts, definitely. And that is who the directors are, company secretary, the registered office address, and potentially the accountant. Now, these are all pretty much available on Companies House, so it's nothing that anyone couldn't already potentially find out about you and your company. The next one is our director's report, and thankfully, even for a small company, the director's report is again quite limited in its framework, and there isn't much that you need to actually be including. And the key thing here is it's reporting the directors and any appointments or resignations that may have happened, and it's also stating that we're using the small company provisions. And as you can see, it's saying that we prepared them in accordance with these provisions, that we're entitled to those small company exemptions. And this is one of those standard lines that you would expect to see in your set of accounts, because this is a legal requirement. Then you will sign the director's report, one or multiple directors, depending on what you want to be doing. This then leads us on to our next page, which is basically the accountant's report, which says we've prepared these accounts, we've done them to the best of our abilities, we've confirmed the information with the client, with the company, but they're not audited. And that's kind of the key phrase here. This isn't an audit report, this is just a preparation report to say that we as accountants have prepared these under these standards. Now, this then leads us on to our income statement, or our profit and loss account in old terminology under the accounting standards. And this basically shows you what's happened in the year, as you would expect. It's showing your income, your turnover, which is probably likely your rental income, any direct expenses, gross profit, any overhead expenses, which are more the things that are running your business rather than actually directly related to the property, and down to your profit, tax, and profit after tax. Now, this is in a set format, so you'll expect to see it like this every single time. There is no, I want it in this format. This is the legal requirement, and this is how it is prepared by all accountants, which kind of covers both things. There will always be a comparative unless it's your first year, and that will show you the two areas of where you have been and what has been achieved in the current year. Now, that moves us on to our statement of financial position, or balance sheet, depending on which terminology you are familiar with. Now, this is where you'll be able to see your fixed assets, you'll see your current assets. So fixed assets, you'll have your tangible assets, or potentially your investment properties. And there is a separate category which you would have in your accounts which says investment properties. We then have potentially any stocks. So if you're serviced accommodation type business, you may have stocks of shampoos and other bits and pieces. For a lot of property focus, more buy-to-let, HMO, that type of thing, you've probably not really got stocks, but you may have some debtors if there is some tenants that owe the company money or haven't paid their rent, but hopefully, touch wood, that is not you and all your tenants are paying and up to date. We'll then have the cash at bank, so that is literally what money you have in the bank at that date, at the end of that day. And then that leads us down to any creditors, which is going to be things like your mortgages or your investor loans or things like that. There'll then be a few numbers, which net current assets is just a calculation of the previous figures above. Your total assets less current liabilities, again, it's just a calculation figure. Then your creditors, more than 1 year, that is probably going to be any mortgages. Your under 1 year is maybe your bridges, your investor loans if you're doing 1 year. The creditors more or less than a year will depend what you've actually got in place in terms of financing, or any other contracts if you've got any HP agreements or anything like that. We then have the provision for liabilities, and this is where things like your accruals are going to be. So your accountant will accrue a cost for their fees and things like that, or other ones, maybe a bad debt provision. If you've got people who owed you some money but you don't think you're going to get it, you'd include the fact that you're owed the money, but then you might put a provision against it to say, well, but I'm not actually going to receive it. And you may have a provision before you actually write it off. So there's a few different entries that you may see in some of these areas. Now, this comes down to your net assets figure, and this is the figure that is basically what's the company worth. Now, the ideal is that this is positive. Now, I know I see on a few balance sheets that it is negative. If it's negative, it means it's insolvent, and you as the directors are personally liable. So ideally, you want this to be positive, and over a period of time, normally 2-3 years, especially when you're getting going, that's where it heads to and that's where it gets to, which is the ideal situation to be in, because that means the business is running well and you actually have some equity, some value within your portfolio in your lending position. We then at the bottom have our called up share capital, so this is who actually owns the company, and we'll then have our profit and loss account, and in property accounts we tend to maybe have a revaluation reserve as well. Now the revaluation reserve is basically, I bought it for 300, I've spent 100 to 400, but now it's worth 500. Now obviously I've not actually physically put that extra 100,000 in, I've just revalued it up to that because that's what the lenders have agreed to lend me. So that's where at this point we would have a revaluation reserve of say £100, £100,000, and it would sit as a value in your capital and reserve section, because obviously that money isn't actually profit, but it is additional value in the company. Now at the bottom of the balance sheet we have all the different legal requirements, that these have got an exemption so they're not being audited, that the directors have complied with the regulations to prepare the accounts and collate the records that they need to hold, and that these are in accordance with the Financial Reporting Standard 102, which is the one that we mentioned before. And then the directors will sign off on the accounts. Now in our micro company accounts, that pretty much is nearly it. There's like 1 or 2 disclosures. But because we're on small company accounts today, there is a few more bits that we need to look at. So let's look at the notes that then go alongside the accounts. Now the first note that will be in any small company set of accounts is the accounting policies. Now accounting policies are how you as a company have decided to run the business and how you treat different transactions. Now the ones we have here, the first thing is a general information statement, and that is really to say it's a private company limited by shares, which is what you will likely have in yours, where it's been registered, which most companies are going to be England and Wales, and then the address of the registered office address, which has been highlighted earlier, but again it's just one of those notes that is a legal requirement that we put in here. The other thing that we'll tend to find in this section is potentially the currency that the accounts have been prepared under. Now we've then got our statement of compliance, which is basically we've prepared them under FRS 102, section 1A, and it's really just to state what process we have taken to get to these end results. And then the final section is we get to the actual accounting policies, and this is what the turnover is. So this will be, we have received rental income on a monthly basis, excluding any value-added tax, and it's recognised at the point that it's been received and it's been certain. So these are just certain things. Our current tax will be literally the current tax side of things. Tangible assets will be how they're measured, and as you can see on screen, it's relatively obvious things, but this is to ensure we're complying with the accounting policies and the accounting standards. The micro company accounts are prepared in a similar sort of way. We're just not required to put all this additional narrative into those accounts, whereas in the micro company accounts we are required to do the detailed information. So this kind of takes us down. As you can see here, we've now got our depreciation, so any other equipment. So if we've got computer equipment, so maybe you've got an iPad, maybe you've got a computer that you've got in the business, all these sorts of things will be at the point where you add them in and put what your depreciation rate is going to be. So that might be 25% on cost. So each year you say, I've got this iPad, I've spent £1,000 on it, and it's going to go down in value by £250 for the next 4 years, and then it's worthless. All these things need to be dealt with, And this is where the accountant is probably going to be supporting you and helping with make that decision on what the appropriate policy is going to be. We've then got things like impairments, finance lease, financial instruments. I'm not going to dwell on those because they get very techy very quickly. But this is where your accountant is really going to be coming into the element to make sure that you're complying with all the rules, legislation, and following through on how it needs to be collated together. One thing to mention is deferred tax, because this is one area that in a micro company account, deferred tax is completely ignored. Now, in a small company set of accounts, we have to do something called deferred tax calculations. And this is basically looking at, I don't have any tax to pay today, but I've revalued a property, and when I sell it in the future, I will have to pay tax. But we have to acknowledge that tax today, not just in the future. So the deferred tax calculation is basically looking at what we've got in the accounts and going, actually, at some point we'll pay some tax on that. We need to bring that adjustment in now. So not really anything you can do about that. It's just something to be aware of. That is happening, and that is what one of your accountants will be doing to make sure appropriate adjustments are made in your accounts. Now, we've got the average number of employees note. That is in every set of accounts, so that will have been in the micro company, is in the small, and will be in any large sets of accounts as well. We've now got our tangible assets, and there'll also be an investment property note. Now, in these set of accounts, I've not got investment property, but there is a separate note for that type of asset. And this, you'll kind of be able to see we've got the split of the cost, anything we've added onto it, any that we've disposed of, to give us our value now of what is actually happening, and our depreciation of what the value has gone down. Now, investment property we don't tend to depreciate because we don't need to, we aren't required to, because theoretically we're buying them for the increase in value rather than the depreciation value of it. So on that basis you don't have the depreciation, but it may be we need to do something called amortize it or impair it. And this is where our property was worth 500 but the market's crashed and now it's only worth 300, so we may have to do an impairment to reduce the value to 300. So we don't depreciate it on a regular basis, but we may need to just assess, is there any changes in the market, is there any changes in the value, do we need to do something like impair it and reduce the value. So again, something a qualified accountant will work with you on and talk to you about when they prepare that set of accounts, to see if there's anything that would be affecting your valuations of your properties. Now, this then takes us down to our debtors note, which for us hopefully is going to be relatively straightforward within a property industry sector, but then anybody who owes any money. We then have our split of our creditors, so this is any bank loans, any actual trade creditors, if you've got any trade accounts with things like Wolsey, ERF, electrical, these sorts of places where you may be working with them on a regular basis. We've then got the taxation, that's what's owed, and then any other creditors. So this may be any investor loans, any other people that you owe any money to. In this area, we have our bank loans, and these are dealt with under an amortised cost basis, which again, I'm not going to dwell on because this is very much an accounting adjustment that your accountant will be helping and making these adjustments for. But it's just something for you to have go, oh, they are doing something on this area. It's not quite a matter of just put one figure in. There is a few technical adjustments that need to be made in this area, and this is where you'll start to see it in the accounts with some of those tweaks that are made from those accounting adjustments based on the accounting regulations. Now, in this area, we'll also have any secured debt. So if you've got any personal guarantees, any loans that are in place, there will be a section or a note which just details this here. And here we can see I've got a guarantees and other financial commitments note, but depending what you've got going on in your company, there may be disclosures around that to just make sure that everything fits together and is declared in the appropriate manner. One of our final notes is then our directors' advances and credits and guarantees. So this is if you owe the company any money rather than the company owing you because you've taken more than you should have out of the company. this is where that note will be shown and just explain what has happened so that it's clear to anyone who is looking at the company. If the company just owes you money, then there's actually very minimal to no disclosure on that, because you are just a creditor of the company in the other creditors note further up, as we just saw. Now, the next part of the accounts which we go on to is then the detailed income statement or profit and loss account. And this is a non-statutory section of the accounts. So when we do send into Companies House, we take out that income statement, we take out any notes that relate to the profit and loss, the income statement, and this detailed profit and loss income statement at the back of the accounts gets taken out because we don't include any of these different information. And as we can see, this is just the turnover, what's it made of. So it's just a bit more information rather than at the moment we've got one figure, but is that one figure made up of 5 things or is it made up of one thing? This is where we'll be able to see depending on how it's been posted into your accounts. And then we've got kind of cost of sales, which for us would probably be things like it's our energy costs, it's maybe our council tax, it's going to be our management fees. All those sorts of things would come together to make those cost of sales. We've then got other costs, so this is like our overhead. So if we've got a director's salary, it's probably going to be coming down into this section. If we're doing general marketing, maybe doing director vendor marketing strategies, it could be we're doing networking events or we're part of collectives or doing training. All of those sorts of expenses will come down into these other costs, administrative costs further down, which then kind of leads us down to any interest we're paying, any loan finance, and then the final bits would be your corporation tax, which is calculated based on what's gone into your accounts to give your final profit and loss for the year. And that in itself collates everything to pull together your set of accounts. Now, as you can see, if you've looked at the micro company, there's a few more pages, there's a few more disclosures, but this is a lot less than if we were doing the full financial reporting standards, where there's a lot more disclosures. So we're kind of going from the full disclosure down to the small disclosure down to micro, and it's just figuring out which is going to be the right one for you. And for a lot of property investors, there's the choice of the micro accounts and the small company accounts, but the small company tends to work quite well for a lot of them with the revaluation side of things. As you can see, there's quite a lot that goes into a set of accounts, so it's not just a 5-minute activity. And the key here is that you're keeping your records over the year to keep everything together, to then provide to your accountant to really get everything together. But hopefully from there you can see what is actually in the set of accounts that they're going to produce for you and what the different things are. If you do have any questions about any specific area in the account, then please do leave a comment and we can go into the more specifics of that area of the accounts and what it means and why it's there. Because this is what is going out to the world, this is what the banks are going to potentially be asking you for, so you need to really understand what is happening in your accounts, because that's what you're going to be producing for the world to see how your company, how your business is doing. Hopefully this has given you more of an insight into this area of your business, the finances of your business. And if there is any questions, please do leave a comment. Hopefully today you've discovered what is in a set of limited company accounts when it's under the small company regime and how it fits together and why you would use them. If you do have any questions, please do leave them and we'll get to all of them, and we can add an extra video if there's more you want to know about this topic. Please do like the video and do subscribe to the channel to catch up on more property tax and accountancy related topics. Let's make tax less taxing. Let's make tax less taxing.